Welcome to Trading Pro. In the previous session, we studied the trading strategies associated with failed range breakouts. In today's session, we will learn how to trade successful breakouts. When the price breaks through a stage point, trend line, or range, it usually behaves in several ways. Beginner traders, often not understanding the differences between these behaviors, will jump in upon seeing a breakout. However, as price action traders, we should understand the differences between these breakout methods. Some breakouts are ones we should avoid, such as a rapid range breakout. Let's look at a case of range breakout. The candlestick pointed out by the arrow indicates that the market had already formed a trading range before the breakout, confirmed by 3 resistance levels. We can see that the breakout was rapid and continuous, with little pause in the price. This rapid movement within the range can easily exhaust the momentum, often leading to a false breakout. Rapid breakouts are a type of breakout that I advise you all to avoid trading as much as possible. Sometimes, these rapid breakouts are indeed real breakouts and can trigger a new trend. However, this is a minority of cases. You can review more on your own. Most real breakouts resulting from rapid breakouts occur against a backdrop of a strong trending market. In a strong trending market, there is no problem with going with the trend for any reason. Furthermore, when trading rapid breakouts, there is a drawback. It's hard to set a reasonable stop loss. When we trade, the stop loss is usually the previous stage point or a densely packed price area. However, for rapid breakouts, the stop loss position is usually far away, making it difficult to achieve a good risk-reward ratio in trading. Let's go back to this case. Suppose the breakout was successful and brought about a new trend. Theoretically, your stop loss should be placed here after entry. With such a wide stop loss, even if the breakout is successful, it is difficult for us to have an advantage in terms of risk-reward ratio. Rapid breakouts in a range could potentially be the beginning of a trend, that is, a real breakout, or they could merely be a climax. During the breakout process, we cannot determine which of the two it is. As it's difficult to set a reasonable stop loss for this kind of breakout, I do not recommend you to trade such rapid breakouts. I recommend 2 breakout entry models. The first is the breakout, pullback, second breakout model. The second is the pre-pressure breakout. Next, I will explain these 2 breakout entry models using real-life examples. Let's look at the first case using the 1-hour chart of Bitcoin. Here we have a descending channel, which is a downward sloping trading range. Personally, I don't like to trade such patterns. Compared to a horizontal trading range, its lines have multiple interpretations, and there are many false breakouts within the range. This can reduce my trading win rate. Some people will enter a long position as soon as the price breaks above this declining trend line. However, if you enter like this, where should you set your stop loss? In my opinion, the best stop loss should be below this stage point. At this time, what advantage does your risk-reward ratio have? If you have rich trading experience and excellent trading skills, you can set your stop loss here, below the breakout candlestick. If your skills are even better, you can observe the strength and weakness of price movement after entry and judge whether it is powerless to break out. However, I think only a very small number of people have such excellent trading skills. Most people should make simple trades. If I were to participate in this breakout, I would wait for a breakout, a pullback, then participate when it continues to break upwards. After the breakout, the price moved for 3 more candlesticks. Let's examine these candlesticks. The first one represents a strong bullish trend. The second one represents bearish power with a long upper shadow, which can be considered as a single candlestick reversal, and it occurs near the previous stage's high. Those who subjectively believe this breakout is a failure may short based on this candlestick, typically setting a stop loss just above the breakout level. At this point, let's sense the bullish and bearish power in the market. When the price pauses after such rapid movement, there are definitely contrarian participants. Traders who subjectively think the breakout has failed enter to short. What if the third candlestick continues to break upward? It's simple. Those who shorted will be stopped out. When the price breaks upward for the second time, the stop loss of the shorts will push the price to continue rising. it could likely be a genuine breakout. How should we handle this in practice? Traders who subjectively believe it's a breakout and a pullback can place a long order above the high point of this candlestick, with a stop loss set below this stage's low. This not only greatly increases the probability of a successful breakout, but also offers a very favorable risk-reward ratio. This entry method is more conservative and advantageous than entering directly at the breakout. Let's see the subsequent trend, a quick and straightforward rise. For those using this breakout, pullback, re-breakout entry strategy, your winning rate is significantly improved, and you have a strong risk-reward ratio. Moreover, your positions are logical, with clear stop-loss points, making your holding more comfortable. Now, let's examine a second case. This is a converging triangle formation, and the trading breakout method is the same as with trading ranges. On this time frame, we see a big bearish candlestick breaking downward. It seems like it doesn't follow the breakout, pullback, re-breakout model. But that's not the case. This model may occur on a smaller time frame. Let's look at it on a smaller time frame. This bearish candlestick broke the trend line and then closed above it. When it breaks downward below the low point of the candlestick again, it is a perfect breakout, pullback, re-breakout entry model. You can place a short order at the break below, with a stop loss set above the point of the breakout pullback. When the market breaks downward again, the chances of a successful breakout are high, with a better risk-reward ratio. You can review many successful breakouts that have followed this breakout, pullback, re-breakout model, whether in parallel trading ranges, converging triangles, upward or downward trading channels, or even just a single trend line or horizontal line. Once you master this model, you will be more comfortable when trading breakouts. Next, we will discuss the second breakout entry model, pre-pressure breakout model. Let's look at a third case. We are mainly concerned with the price breaking the key level here. The final rally seems to be an attempt at a breakout. It paused as it approached the top of the range. With consecutive overlapping candlesticks representing a narrow trading range, the dense price area at the top of the range represents a standoff between bulls and bears. Both bullish and bearish views can be considered here, depending on your subjective judgment. Since this lesson is mainly about successful breakouts, assume you're a subjectively bullish trader. You can place a breakout order here, above the dense price area, with a stop loss set below the dense price area. For subjectively bearish traders, simply reverse the process. As the price breaks above the dense price area, all the short traders will be stopped out. Their stop loss orders will push the price to continue rising. Let's look at the subsequent trend. This state of pre-breakout pressure can be utilized by both traders who want to trade the breakout and those who want to trade the breakout failure. It provides a clear breakout point and a clear stop-loss defense position. Let's look at this case. Here we have a horizontal resistance level. Pay attention to this long trending candlestick. This is why I advise against trading rapid breakouts. They can easily cause a depletion of momentum, like in this case. If you enter during a breakout, you'll get trapped. We then observe that the price has paused, forming a pattern with several overlapping non-trending candlesticks. You can refer to it as a barbed wire, a micro box, or a small trading range. The name isn't the important part. What matters is the meaning it conveys. The price has paused here. Some of you may ask, isn't this pattern a false breakout in the range? In fact, I've always emphasized that when the price pauses during a breakout, whether it's a pullback after the breakout or a failed breakout, is entirely subjective. We can't make a judgment beforehand. Why can we make money trading this pattern? Because we have clear logic for entering the market. The advantage of our trading lies in the win rate and the risk-reward ratio. Most of the time, breakouts above or below are 50-50. If you have a good risk-reward ratio, it means you have an advantage mathematically, which leads to consistent profits in the long run. Let's look at the subsequent price movement. The market chose to break upwards. Now let's look at another case following a breakout from a range. Price doesn't only pause during a breakout from a range. Sometimes it can be indecisive even after the breakout. We see here a clear trading range. Because our main focus is on the state of the market after the breakout, we notice that the price initially made a rapid breakout from the range, even significantly breaking below the previous wave's low. Many people would consider this a successful breakout. However, immediately after the breakout, instead of continuing its downward trend, it forms a small box. We refer to this small box as a small trading range on a smaller time frame. At this point, whether this breakout from the range was successful or not is up in the air. The smart ones among you should know that it's 50-50. Before this small box is definitively broken, the odds of it moving upwards or downwards are 50-50. Whether it's a successful breakout or a failed one is unknown. It depends on your trading perspective. If you are subjectively considering this as a successful breakout, then you would consider this a pullback after the breakout. However, if you subjectively see this as a failed breakout, you'd view this box as a sign of lack of follow-up power after the breakout. But what it actually is, we only know after this small box has been broken. For instance, it is broken below now, so we know this is a pullback after the breakout. This lesson mainly discusses breakouts. For a trader who primarily trades breakouts, how should they operate at this point? We say, we don't enter during such rapid movements. After it has broken below, the market forms a definite box. Now, as a trader who subjectively trades breakouts, it's simple. You short here and placing your stop loss here. If you're more advanced in your learning, that is, your technical level is higher, you can still apply the breakout, pullback, then breakout again entry pattern to this small box. That is, you go to a smaller time frame to find that breakout, pullback, breakout pattern, and your stop loss could be placed even tighter. Let's take a look at another example. Just like the previous one, a smaller box or a range was formed when it broke the lower boundary of this range. Whether this small box is a breakout pullback or a failed breakout depends entirely on your subjective view. An important point to note here is that we can see there's a breakout, pullback, and second breakout entry pattern. How can we recognize this? The first candlestick is the breakout candlestick with a very long lower shadow, indicating that the price first broke out downwards and then rose upward. Later, the price broke the point of the first candlestick. If you don't understand, you can look at a smaller time frame. On the smaller time frame, there will definitely be a breakout, pullback, and second breakout entry pattern. However, we notice that this pattern has hit the stop loss and was denied by the market. Even such a conservative pattern could hit a stop loss, and there's no way around it. In trading, even the best patterns and the best systems have times when they hit the stop loss. You must accept this. Many novice traders can't quite accept losses, which is wrong. You must learn to set stop losses in trading. Otherwise, what awaits you will definitely be a total loss. So, how should we operate at this time? Let's say I'm a trader who subjectively believes in a successful breakout. Then I would enter the market when the box breaks down. If I am more aggressive, I would place a sell order above this small trading range. Since I subjectively believe that this breakout is successful, I would assume this small box will also break down. The logic of selling high and buying low in the range is correct, so my profit and loss ratio would be very high at this point. If you're a trader who subjectively believes the breakout has failed, you can simply operate in the opposite manner. At this point, you'll realize that the winning rate for this kind of pattern is not important. No matter how you analyze it, the winning rate is 50-50. The key is your mathematical advantage, namely a high profit and loss ratio. Let's go through another simple case. This is the 4-hour chart of the Canadian dollar against the Japanese yen. Here we see a clear horizontal resistance. The first attempt at a breakout failed. We see that after the breakout, there was a significant pullback, falling back below the resistance level. However, new buyers stepped in afterward, causing the price to rise again and break through the previous stage. So the initial failure of the breakout turned into a successful breakout after a pullback. This exemplifies a point I often make. Until a successful breakout occurs, we don't know if a given breakout attempt will fail or succeed. It's all subjective. Many traders struggle with this multiplicity of interpretations for price movement. During my trading learning journey, a mentor once told me something I found very profound. He said, no matter how smart you think you are, there's always someone just as smart as you with a completely opposite view. Many beginner traders struggle due to an incomplete understanding and lack of trading experience. When faced with unexpected price movements, they're often unsure what to do. For example, they might have just learned a breakout pattern, and when it doesn't go as expected, like a bull flag that doesn't break upward but accelerates downward, they're left clueless. It's not what they've been taught. However, as a trader who can survive in the market, you must be able to handle any price movement. There's no such thing as a perfect trading system or technical analysis method. It's impossible to have a system where certain conditions always result in profitable trades. You have to accept the variety of market movements. For instance, a beginner trader might learn about the head and shoulders reversal pattern. Once they enter the market and find that the market isn't reversing, they're at a loss. This is why it's crucial to build a comprehensive knowledge base and refine your trading system to handle any complex market conditions. Regardless of the market's movements, you should understand them clearly, but only a few are willing to settle down and study diligently. Most people trade based on feelings, rumors, or follow someone else's trades. They don't have a comprehensive knowledge system or trading logic. The reason I'm making this video is to help those who are genuinely interested to understand the essence of trading. I just want to say congratulations. You are so lucky. That's for today's video. And if you like this content, please like, comment, and subscribe so you won't miss out. And I'll see you in the next video.